Good morning, everybody. Welcome to the Flow Show. It is Monday, the 16th of June, and nearly the middle of the year. 5 more days to go, and then it starts getting darker. We haven't even got there yet. We haven't even got to summer yet. Morning, Kay. How you going, mate?
Yeah, morning, mate. Morning, everybody. Yeah, nearly there. Starting to think about Christmas, perhaps then in a couple of days.
Oh, come on now. We've got Halloween first.
Oh yeah, true.
Yep. So anyway, looking forward to some sunshine. I managed to get my old noggin a bit burnt. We had a bit of good weather over here, so I've got a bit of red on my old bonts over the weekend, Father's Day. It was a nice outing with the family and that. Anyway, right, enough of that. Let's get on to what's going on in the world. Going to start with a bit of data. We had Chinese data out over the weekend or early in the hours of today. Retail sales came in pretty healthy for May, up 6.4% year on year. We're expected to come in 4.9%, down from the 5.1% previously. That came in okay. Industrial production, a little miss of expectations, but still hefty numbers going on there. I read some capex numbers as well, a little softer than expected. The unemployment rate improved to 5% from 5.1%. Stats Bureau said many global uncertainties persist, but economic recovery foundation needs strengthening. So they're not quite ready to declare victory or anything there. They're still potentially looking to keep the economy well supported. Over in Japan, Finance Minister Kato said that talks with markets are key for bond issuance. The BOJ is this week, and we've got pretty much all the headlines are going to be around what they may do with bonds. Also, the Finance Ministry as well, with that rumour that keeps rearing its head as well, encouraging more domestic investors to buy into JGBs. They've potentially got another call with investors after the BOJ. This is the Finance Ministry or the BOJ, I can't remember which one, but they're still all going to be talking about this stuff. Potentially after the meeting, so we could get something at the meeting that they then need to sit down and discuss with them. Who knows? They might have had those discussions already. Anyway, moving on from that, PM Ishiba on his talks with Trump on Friday said they agreed to accelerate talks for a mutually beneficial deal. According to Kyoto, Japan and US leaders are arranging to meet tomorrow, 17th of June. That's at this G7 shindig, which has been going on all weekend and continues through to tomorrow. There's not been that much news on the trade front from that, any big deals announced, but they may still come over the hours ahead. A survey picked up by the FT for the UK says that the US is no longer a top growth region for UK manufacturers. The US has pretty much been sitting first, second spot for a long while. It's now dropped out the top 3 due to everything going on, tariffs and trade and all that sort of stuff. But the UK looking at other markets too, which isn't necessarily a bad thing. ECB's De Guindos says that the markets understood the ECB message and that inflation is very close to target. Says the euro dollar at 1.15 is not a concern, and says that the appreciation is not rapid or volatile, which again is a little bit of a green light that they're not fussed about the levels of the currency at the moment. Says the risk of undershooting the inflation target is very limited and inflation risks are now balanced. It says tariffs to lower both growth and inflation in the medium term. ECB's Nagel says uncertainty is already far too great. We must retain full optionality on interest rates. It says data and forecast suggests its mission accomplished for the ECB. Another victory lap there. Says the sustained inflation undershoot is unlikely. Kate, those ECB bods getting a little complacent, maybe?
No, I don't think so. I think it's part of the plan, Ryan. You know, they're still okay. They're independent. They shouldn't be talking about it. But then, you know, like Jargon and others are always talking about fiscality and stuff. They know that investments into Europe are pretty supportive for everything that needs to be done. Yes, it could continue to dampen inflation on the one hand, but I'm kind of in the camp that they are willing to take that risk right now, because as they also need a stronger economy. And if you see investments coming in from abroad, whether it be as a part of a little more, how shall I say, confidence in the Eurozone, but then also a lack of confidence in what's happening in the American zone. I think they're playing it a bit strategical there, and by saying it's okay, guys, if you think the euro or the Eurozone is a place for investments, it's okay. I think they are rather playing that side instead of being complacent about things. Was it Nagel this morning was out saying can't say whether the risks are going to put them on hold or needing more intervention on the rate or on the monetary policy. But in the meantime, I think it's kind of done on purpose, you know.
Yeah, maybe. But we need to differentiate between investment. There's investment in markets and there's investment in countries. And at the moment, the flows we're seeing is not investment in countries. It's not big firms saying, "Yeah, we're up in sticks from the US and we're going to open up in the Eurozone." That's a different kind of investment, a more long-lasting investment. The investment we're seeing, investor in at the moment, is more moving money out of the US and parking it in Europe. So that's a different kettle of fish to
Yeah,
investment.
they want to keep it there. That is, I think, part of the plan or part of the strategy that they are now. We have seen, and there were a few articles doing the rounds lately. We have seen a few of the bigger investors seeing opportunities in countries, and they're not like talking about bond or monetary or currency investments, but rather talking about undervalued or low valued companies and stuff. So I think it's there's a bit of both going on right now. And if you invest in companies, then that means that the companies have more money to them in turn invest and continue to build. So I think it's a bit of both going on right now.
Yeah, thanks, mate. Bit of data on Friday from the US. Not a lot out, but we had Michigan consumer sentiment and another improvement there in sentiment data. A nice jump to 60.5. Was expected only a marginal rise to 53.5. Current conditions also improving there. Expectations up as well. And then we saw another pullback in the inflation metrics. Was expected to come in at 6.4 on the 1 year from 6.6, came in at 5.1, and the 5 year coming in a bit lower than last month at 4.1%. So we've seen this with sentiment surveys now, particularly since Trump announced that all this trade deadline stuff is going and deals are being done in the market, or I'll say the market, the consumer at least, feeling that things are a little bit stressful as surveys of this kind can move. Now, this upbeatness has got to continue. And if it does continue, then it makes the last few months less unlikely that we're going to see those effects playing through into the real economy. But we still sit here on the 16th of June and still not one trade deal has been signed. Lots of stuff on the go. Even the India stuff hasn't been rubber stamped yet, and that's potentially the first deal that's been going on. So still in the possibility that things could go wrong, but we also have some potential good news, some confirmation moves yet. to come once we get all these deals announced, if they get announced, of course, and how good those deals are, whether Trump then moves on to the next thing. So as I like to say with sentiment surveys, you follow them. You wouldn't trade on the back of 2 or 3 sentiment surveys, but what you want to look for is whether that sentiment starts feeding into activity. And as the hard data has shown, we haven't seen that yet. So may still see some effects coming through, but as I say, if the positivity continues, then it will look a bit of a blip and the US can continue. And then we might have to look at the other side as to not whether the US sees any wobbles, but whether we see activity picking up, and which brings its own challenges with it as well, like added inflation. Anyway, moving on from that, Mr. Trump doing a little bit of seemed like backpedaling and arse covering on Friday regarding this Iran stuff, after saying that he didn't know what was going on, didn't realise that Israel was going to be attacking, which of course is bullshit. They all know what was going on. But anyway, for the population, he said that he gave Iran every chance to make a deal, and that Iran must make a deal before there is nothing left. Still hopes for a deal between Iran and Israel, but sometimes you have to fight it out. Now, the weekend has been spent with both sides lobbing crap at each other over the weekend. There have been more casualties, more civilian-led casualties now than just what was just military casualties. There's been no real change. They're still lobbing stuff at each other. Still, the war of words goes on. But the market has pretty much brushed it under the carpet now. The world didn't end over the weekend, so we've seen a reversal in some of those market moves, rallies in oil, gold not so much, but we're still off a bit. But all those risk off trades and investors taking some hedges into the weekend, those have all unwound a little bit. The market with that goldfish mentality again, isn't it? Nothing bad's happened, and we go back to trading everything else that we were Thursday afternoon.
Exactly, Ryan. The goldfish has swum another round in his bowl. Yeah, there's not too much else to be said about it, because that's exactly what happened, right? We saw trying gold, for instance, trying to rally again, but it's coming off now as well. Those markets, it's all. Yeah, it's really moving from one side to the other. Put on hedges, take them off. I think it's better to be a market maker than a market taker in these kind of markets. Yeah, that's sort of what we can say about it. What is really telling is the oil. The oils just can't keep the rally. We are like $7-8 of the highs already. It's 10%. I mean, it's not a move that it is. Those are pretty big moves, right? But there you see how nervous on the one hand, but then again, we are back in that scenario. We're exactly back in that scenario that we started since the war in between Ukraine and Russia, and you see those violent spikes. This time, people were really fearing the worst, and we're not out of the woods by any means, by the way. An Iran which is really going to be pushed to the limit. Let's hope not the ultra worst, but an Iran they could start to target boats in the Strait of Hormuz, trying to close the strait and stuff like that. And then your oil is probably going to ramp up $10 again. But we are still in the same scenario where you see those violent spikes and they can't hold them. And it is just ongoing. It's quite crazy actually, this oil market, because it's something that if you're a pure FX trader, it's something that is quite actually spectacular to look at, because one may think that with two conflicts, two conflicts which are very much alive and ongoing, that oil just can't keep the beat. I mean, this is quite spectacular, I must say.
Yeah. I mean, I remember the days, you used to do that every day, $5, $6 moves. You've only got to look at a big old chart to see, some of these big moves you used to get in oil markets. As I say, it always has been a very volatile market. It's been less volatile of late recently. You'd expect something like Iran stuff, $10, $15, $20 swings quite easily. But maybe it's just an effect, Kay, of volume. Now we're seeing more people trading it.
Yeah.
It keeps it in check a bit more.
Too much money in them? Well, not too much, but a lot more money in markets as well, and that money needs to be hedged or put somewhere. And but we have the other side of the medal as well. There are conflicts, yes, but on the other side, they have been cutting prices, upping output. The OPEC Plus, the Middle Eastern guys. They expecting a bit less demand from the other side, unless of course we see a revival and Trump succeeding in what he wants to do in bringing all that economic activity back to the US. Then you would see a big surge in demand, of course. But in the meantime, the demand is outside of those conflicts is gradually coming down, where the output is now back up. So that's the other side of the medal. But yes, for there's so much more money in the system now than we had before, and I guess it's part of the reason why we see these kind of moves and then peter out.
Yeah, far more liquidity in these markets, so it takes a lot more money to move them. Long and short of it. Right, that's it on the headline front. Unless you've got anything else, Mr. K?
No, mate. I mean, we have that G7 ongoing, but haven't seen any big decisions there yet. The one thing which was a little interesting is that Canada is pushing for the UK to be finally taken up in that CPTPP stuff with 12 other countries, which would be also probably a welcome diversification for the UK as well, if they can get into that system. But for the rest, yeah, we're still waiting on bigger news. The last headline that came just before the flow show was something about Trump not going to do individual deals or so with Canada and Mexico, rather continue to work under the USMCA umbrella right now, which is due to be revised completely, they said, in 2026. So that gives probably Canada and Mexico another 6-7 months to be hopeful.
Yeah, that's right. I can't remember when is the review next year, or is there a review thing at the end of this year? I can't remember.
Well, first of all, well, I mean that's what it's how we approach things, right? He first of all said we're going to completely tear it up, but then reports, okay? I mean all those things have to be taken with bags of salt nowadays, but reports afterwards were saying that the big revision is now pushed back to 2026.
Okie doke. Yeah, I'm just having a look, see when it was. If I can find it. Yeah, there's a review clause for July, apparently.
Sorry?
There's a review clause for July.
Yeah, that was the start of it, but yeah, okay.
They can change it. They can change it as they want. Sorry, mate.
Yeah, exactly. I think it's been pushed back a little, but we will see, of course. Yeah.
Yeah. Always easy to move the goalposts on that. Right, let's have a butchers what's coming up this week. We've got, I don't know if we've got any others, but we've got three major central banks anyway this week. The Fed, Bank of England and the Bank of Japan. Have we got any nudges? I haven't even looked, mate. Got any nudges?
Yeah, Sweden. We've got Sweden as well. And then well, then the other, I mean, a few minor ones as well. Turkey, I think, but okay. And there's a couple of other ones, but I really forgot who they were.
Yeah, yeah. So anyway, we've got the major ones to keep an eye on. So today we get the start of the manufacturing month, new month for June. So we get the Empire State popping up first thing in the US. Maybe we'll see if there's been any improvement in that number with all this trade stuff going on. That'd be good to see. Then tomorrow, got now I always get this one wrong. Tomorrow's not the BOJ morning, is it? It's Wednesday, isn't it? Or is it tomorrow?
It is tomorrow.
Is it tomorrow? They started already today. Okay. Because
Yeah,
sometimes this
yeah.
calendar gets it wrong. I thought it was the 18th they announce.
I guess it's tomorrow, mate. It's tomorrow. The calendars are talking about it for tomorrow as well.
Okay, so that'll be the earliest of tomorrow. We'll talk about that in a bit. We've got German zoo survey, so we get to see whether things have improved in Germany. Then we get a ton of US data, retail sales being a key metric ahead of the Fed, though we're not expecting much from the Fed on Wednesday. UK CPI could be a bit spicy for the Bank of England because the market getting a little bit dovish on the bank after the jobs data last week. So if we get a real soft number in CPI this week, it's probably going to see some last minute dovish expectations coming in for the Bank of England, which is going to put a bit of pressure on the quid. Eurozone inflation, which will be the final May, I think it's a final May reading. Was it the flash number? No, where are we? For May, yeah. So the final numbers for May for that one. Probably not much to write home. Oh, I've lost my page now. Bloody hell. Why did I close that? Let's get it up again. There we go. Where was I? On Wednesday. Yeah, jobless claims. We'll keep half an eye on that one, considering it's been ticking up a little bit. Still not any numbers that I think's worrisome, but the market, we know, is in that mood to whack the dollar any which way it can. Housing starts and permits kick off the housing run for this month as well. This will all be May data. And then obviously in the evening, we get the FOMC. On Thursday, get some Aussie jobs data. And then it's the Bank of England and SMB. Oh, I missed that one nearly. Okay, the SMB is out as well in the morning.
Oh, I thought you mentioned that.
No, I missed that one. A lot of talk at the moment, not that they'll do it at this meeting, but a lot of talk of whether they're going to be forced to go negative on rates. CPI expectations forecasts over there coming down. Friday, we get Japan CPI data. That comes not too long after the Tokyo numbers, but that might have a little bit of an influence over whatever the BOJ have said. UK retail sales on Friday as well, and then we get to see whether the Chancellor's made a mess of the country's finances once again. Canada retail sales on the Friday, and Philly Fed manufacturing there too, and that's wraps it up for the data wise. So let's jump back to the BOJK. We've spoken about this all last week anyway. No policy change expected, and all eyeballs on whether they tinker with the bonds. Hello?
Yeah, hello?
Yeah, you're on mute, mate.
Oh, you were asking me something? I thought you
just about the Bank of Japan.
Yeah, well, yes. I think it's pretty clear now that they should be on hold. And then this bond tapering going on. Will they halve it? Will they not? But it's if the market gets what it wants, perhaps yen just a tad weaker, but Ueda could come out saying that, okay, we are doing this scaling back of our QE tapering, but this leaves the door open for further rate hikes. So there's a few things that can surprise is a big word, but can a few variables that can be interpreted one way or the other, I think still. And then we have, because on the 20th, you spoke about this inflation report, but we also have that famous meeting with market participants, right? That the Bank of Japan had organized or has organized. So perhaps we should take both as one, but although there's 3 days in between the different events. But yeah, there's a couple of potential variables in there or variations. Will it have a big impact? I don't know because everything has been so well telegraphed now that I'm not sure whether we are going to get big surprises for the market.
Yeah. It's a tough one because it's got the potential for algo moves. Because obviously,
Of course.
if they cut QT, then that can be seen as potentially easing, even though the likelihood of why they're cutting QT is not for easing measures, but it's for financial stability measures. But then that really has them admitting that there is potential financial stability issues when they've previously said that they're not worried about these bond market moves and nothing has been, too volatile and that. But I think, are they going to cut QTK or just jiggle around what they're going to be buying and reinvesting and whatnot, moving it
Mm,
from the shorter end to the longer end or backwards, whichever way?
yeah. Yeah, well, they had two examples now of how the market could react to what they do and what or what they don't do. They had August of last year and then this year that those ultra long bonds going a bit bananas. They're going to have to be very careful with how they bring stuff over. Yeah, I mean, it is possible that they say, okay, we are going to concentrate our tapering of the QT more on the short end, or no, more on the long end, sorry, and keep the short end as is because there is not too much stress. But I mean, the the amounts that are circulating around in the ultra long bonds are so much smaller as well than what they are in the shorter term, up to let's say the 10 years. Everything beyond is pure flow driven and pure. I mean, there is the market can get a bit ballistic around it because the volumes are lower, but the importance of it is perhaps a bit overdone by markets as well. So yeah, they could tinker with the maturities, which would actually not be a bad thing because then you still let the market do and keep your own potential for continuing to hike later. Scaling back is really giving the market, as you say, something telling the market that the market was right. And are they going to go as far is a bit of a question as well.
Yeah,
But I'm very interested as well in if UEDA or if they really decide to lower that QT amount or it's actually not even QT. They are still buying bonds just at a
yeah,
much lower pace as they were doing before. But if they up that pace a bit again, I'm very curious as to what UEDA is going to tell us regarding monetary policy and the effect of that lowering of the QT on their decisions regarding monetary policy, because it could
yeah,
completely counterbalance it.
yeah, exactly. So the two real outcomes we've potentially got is that they keep their amounts unchanged and just tinker with the maturities, or they cut QT, taper QT. What should we call it? Should we call it unQE rather than QT? I don't know what to
Yeah,
call it.
the un word is not too bad. The un prefix, yeah.
Yeah, so that's it. That's the two possibilities we're looking for tomorrow, and it will be what it will be. We'll
And
find
it'll
out.
move.
You getting
It'll
up for that
move.
one?
Well, I mean, the market will move, as you say, even with
Yeah,
the algos, the market will move because of the dollar yen, because of the yen volatility that we have. You look at all the yen pairs right now. They're all trading quite a bit higher because it's not a pure dollar yen thing only. It is a lot of yen crosses also on the move. If you look at the euro yen, is actually very big. Commodities perhaps a little slower, but euro yen is big like hell. And whatever happens with the Bank of Japan, those things will be on the move as well. So they can have like a bit of a double whammy on the dollar yen as well, because that is obviously the instrument that people use to balance from one pair into the other mostly. So yeah, it will be volatile whatever happens. I mean, I would be surprised that dollar yen only moves like 30, 40 pips on the Bank of Japan.
Yep, absolutely, mate. Absolutely. Right, we'll talk about the Fed and others as we get to those days. No point talking about too much today in terms of what's coming up. So yeah, we'll have a look at some prices. Might as well stick on dollar yen while I'm there. We're back above this 144. We're still sort of middling around some of these ranges, 145, 143s, creeping up this trend line with the odd blip below when the volatility kicks in. Had a little bit of a try up towards that 145 zone there, but we are in a slight uptrend still. Obviously, we've got all this volatile stuff going on, but we are, as you can see, walking this line up. So for me, anywhere between 142s, 146s, and then in between, you've got sort of 143s, 145s as a range to watch and see whether we move either side of that. But as Kay said, probably more volatility going through the crosses at the moment than dollar yen. So we've had a bit of a, as you said, the market goldfish moment, ignoring the risk. We didn't have the world blowing up. So all this move that we got on Friday is all reversed. So euro dollar got back above this high that we had. It broke through up into the 116, pulled back, give or take a few pips that level, back up, back down. Then we had it as resistance on Friday, late Friday on the bounce, but now we're getting back above there. I did a bit of analysis in the room today. It looks like a bit of formality that we're going to 116 again.
Yeah, I agree. Long, and I'm keeping my longs, and it's also PA price action is confirming that that rebalancing of flows and investments and stuff, and I think it's still and the fact as well that ECBers do not fight this move, I think it's already telling enough. And it does bring potentially even more flows into the eurozone or so. But it's a global dollar move again today, because we see I mean Aussie, Kiwi, whatever. I mean they're all higher, but the euro has still seemingly this little toe in front of the rest in the race against the dollar also. It's still, because it is a very big market, so big to move, but it moves. So yeah, I fully agree with you. I think that 117 seems to be written large on it, for what I'm concerned at least.
Yeah, very much so. And as Kay mentioned, euro pulling ahead even in the dollar stakes, because you can tell that because it's going faster than cable's going, which is why we're seeing euro sterling continuing this climb. We had this run up, pretty much tapped the 50 fib. I didn't actually have this fib on last week because I'm drawing it, and now I've remembered to put it back on. Let's go a bit one. So yeah, we tapped up there. I did have a level anyway, 85.50s, which not a massive level, but we had a bit of action up here before this fib was in play. That goes back a bit as well, so it is a bit of an area as well up there. Another sort of minorish level, 85.70, but if we keep this going, the 61.8, just shy of the 86 level, is going to be important as well. And we had a bit of resistance up there on after this breakdown that we had, so that's going to be another bit of a zone. And further out, we've got an even bigger zone up here in the 86.5 86.70, another big old traffic area that's seen a lot of action going back and back and back historically. So all these big levels to come. And despite me feeling still thinking that the ECB are going to have to cut again, my timing's probably out on that one. And this, I can see this rallying higher because there's no way I see the Bank of England coming out hawkish or undovish from this meeting. But if they're not as dovish as the market wants, we're probably going to see a dip in this. But I think that dip is going to get hoovered up pretty quickly. And if I see this zone here, 84.80 holding on a dip like that, then I might even scale in some longs and just see if I can ride this train a bit longer. Kay, can this one continue motoring, or are we going to find a stretch point at some point?
On the basis of data that we had of late, I'd say yes, it can go higher. The problem is, as you say, the Bank of England and where the interest rates are. It is a fact, and as we've been talking about, that the euro is doing better than the sterling, which when usually it would be the other way around. When the dollar weakens, usually sterling goes a little faster than the euro, just because of liquidity in the pairs as well. I tend to agree that we can see a bit higher on the basis of the crosses, but then on the basis of sorry, demand and data. But sooner or later, if nothing really worse happens in the UK, the market may start to look back at what you say, like the interest rate differentials is um, after another wave perhaps of demand in the euro, is it going to be sufficient? And then we may be turning that ship around. I would rather, if you look at it at the longer term, we could go up to that. Where is that blue zone that you have there, just
Up here.
above? Yeah, that one.
Yeah, it's about 86, 45, 50 to 70. It's a bit of a wide one, but
Yeah, but that's all right. I mean, could be that one's enough, or that biggish red line right above there, and that would not change a lot in the global scheme of things. I mean, we're still talking about 2-3% moves where other currencies are moving a lot more. This is euro sterling, right? It's not your biggest mover unless there is a big divergence popping up, or an event like we have seen Brexit also. But no, I tend to agree with you. It's holding. It's holding, and we could be pushing a bit.
yeah, absolutely. We'll see what happens. That one's going to be a slow burner, but it's going to move nevertheless.
Bank of England, maybe, yeah.
Yeah, it could be. Yeah, as I say, if they are dovish, which I expect them to be, depends how dovish. I mean, the votes, even if they stay on hold, the votes will still tell the story. So if it's a close one, like a 5-4, something like that, then that will see the pound weakening, and this one will be heading higher, much higher, I should think. Right, Matt, I'm going to ping it over to you for a couple. There she goes. You're on mute, mate.
Yeah, sorry. Let's start with gold, and it's still very, very bullish, right? I mean, it's undeniably still very, very bullish. We've also broken above the triangle, broken above that resistance zone here again, and but we're seeing relatively quickly, even though it shot up because of the situation in geopolitics is bad right now. But we're seeing more and more these kind of little moves where you do a move and then it comes off a little bit. And as I said, I'm still bullish, but I'm starting to wonder whether there is positioning starting to be in play, because we saw a rally in a lot of metals, from gold over silver over platinum, that Stelios also spoke about on the face show. Um, is the market not going a bit or rushing a bit into positions right now? Obviously, if something goes really worse over in the Middle East, this thing is probably going to trade 4,000. But I'm starting to think that perhaps people are getting a bit rich in positions, because we are starting to see those kind of moves. So any de-escalation may cause a bigger move than a continuation of what we are seeing now. That is kind of where I am right now. I'm not chasing this move, in other words. I feel a bit more confident having euros or having actually currencies versus the dollar than gold now, for instance. And silver, though, is actually showing kind of a similar. And then you have to think about the gold silver ratio, because the gold silver ratio now is gradually coming down, which means also that perhaps the positions in gold are a little rich, or the market is not seeing it through as dark a glasses than what we may expect on those hedges. And so on silver, I'm a little more constructive, perhaps. Going back to the longer term, we can see this. Okay, this 35. This is basically 35. You whether it's 34.90 or 35.15 doesn't really matter much in the bigger scheme of things. But for as long to me as we're above 35, this looks pretty constructive. I think we are going to go higher still. I'm not sure whether on a de-escalation and you see all the metals coming off, we can't go back to 33s or so. But I don't see this thing come back to 26s, for instance. I think it could actually keep a better bit bias than gold. And I am especially thinking about perhaps positioning now in the market, which may be a little rich in gold, but not yet as such in silver. So I'm a little more constructive on this one, but that's more for the medium term. On the short term, I think levels around 35.80, 36 already will be watched. We had that blip last week lower, and it got hoovered up extremely quickly. Yeah, we had that. This is the 4 hour. Yeah, we had that blip lower last week Thursday, and it got really bought up extremely quickly, and that's it's actually going faster now if when it goes up than gold. So this is something where my um, sensitiveness to those metals has perhaps changed just a little bit. Moving over to cable for our good friend Bran, unchanged. To me, still 136, 136 and a quarter. That's the gateway to trade up into those 137s. I think it is going to happen, but is the euro not going to be the one? It may need the euro to lead, okay, to lead us through this 136 figure a quarter. So I would respect that. Downside, interesting though, is that we are holding on this 23.6, and the trend line is catching up. So 135, 15, 20, if we ever get a revisit there, pay attention to what's happening, okay? If it holds again, that could be the trigger for then moving higher. Obviously, if we break below, then we are in a more corrective situation with potentially a move down to 134.5. For the time being, positive, but perhaps a bit slower for any move than what the euro, or the euro will have to lead it through, perhaps, okay? Um, have you showed the Aussie? I don't remember.
No, I didn't, mate. I didn't get it.
Okay. Different look perhaps, but similar, obviously price action. I think we're still in both Aussie and Kiwi are still in those channels on the way up, and retracements are holding. Yeah, we had same thing. We had the how shall I say, the pre-weekend things can go bad move, but then since we did not have a severe, according to the markets, escalation, we are bouncing, and looks like we can have a bit of a test here back of that 35.50 zone in the Aussie. And why not, if the dollar continues to trade on the weakest side, why not a move into somewhere closer to 66? And the Kiwi is exactly the same. Right. I had a bit of a nibble this morning here, thinking that we may be on the move in Euro Swiss and going to test those highs again. But again, even though we get a weaker PPI, we get weaker growth outlook in Switzerland by the Swiss government again. It's again not taking off, and we are already correcting. I think we should be holding this kind of 80-90 intraday if we want to continue on the bid side, and really it's still going to be the driver for whatever happens in the dollar Swiss or other Swiss pairs. I think this euro Swiss, it's still the barometer for Swiss strength or weaknesses. And I really thought ahead of the S&P, who are going to cut their rates to zero, we should be moving a bit higher. But again, Swiss is doing what the Swiss is doing. That is annoy everybody. But if over the course of the week we would see a break of this 94.30, 94.45, then we can trade a bit higher again. Anything else you guys want to look at? I was looking at the S&P as well this morning, but I really can't see too much in this right now. Forming a bit of a channel or a bit of a wedge kind of thing. Support around 59.5, 59.40, and then resistance at the prior high 60.60 or even 60.90. But looking at how the rest of the market is trading, I wouldn't be surprised that, as Simon said in our room, it's OPEX week as well, and the fucking dippers are maybe all over this again, and we may actually have a look back at the prior all-time highs. Why not? Before the week is over, unless we get some severe escalations over in the Middle East. And Ryan, that's it for me, mate. Back over to you.
Thank you very much, mate. Yeah, I think the US Open is going to be an interesting one today. US traders coming in and also reacting to let's call it lack of any massive news coming out of Iran, Israel. So we could see another bit of a leg up in risk again. So keep an eye on stocks, keep an eye on all the other risk pairs, just to see if we get that follow through. Right, that's it for today. Thank you, everybody, for coming through the Flow Show. Hope you all have a great week, and we will see you all nice and early tomorrow. Have a good one.